Hi, it's John Paulamy here, Actionable Intelligence. Today is Saturday, October 25th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you personal financial advice. Anything that you hear or see here is for informational purposes only. Please do your own due diligence. It's your money, it's your responsibility. Okay, let's get into this week's charts. So I like this is the Bank of America Global Fund Manager Survey. We've looked at it before. It comes out monthly. And title of this slide is Long Gold Trade Got Crowded. And this is also acknowledged by the Fund Manager Survey. We see that you see three bars here. You see this is August, September, and October of this year. And you saw as the gold price moved higher through the summer and early fall, or late summer, early fall, that fund managers agreed that gold was becoming overcrowded. And so this is what we've been talking about. These things move in cycles, right? These things, we have a thesis, an underlying foundational thesis that gold and precious metals are going to go higher in the years that are coming along. But that doesn't mean it goes straight up. We've said that over and over. Things get overbought and things get oversold. In the context of a secular long-term bull market where we have the underlying fundamentals that we've talked about before that are in place still and are getting, more, in my view, more pressure on commodities and the gold price. But that doesn't, we have that there. It will lead to higher gold prices over time. Central bank buying, debasement of currencies by central banks, over indebtedness, especially in the G7, G20 countries. We know this. That doesn't mean it goes straight to 10,000. And then we saw, perfect sentiment, overbought sentiment conditions where people were standing in line to buy bullion. We've talked about it before. And I remember I'm not going to get into it. I'm not going to dunk on people. I'm just telling you, it's all about probabilities and observation and understanding how markets work and how psychology works. Now, if you bought at the top and you can endure, declines and just ride it out and know some people can do that, but most people are not psychologically built like that. So when they buy something at a high in a volatile sector and then it goes down 20 or 30%, like some of the gold shares have already, then they get upset. And instead of looking in the mirror and understanding their own psychology, they come into the comments and castigate the person that gave them the bad news. I've experienced that even there all the way back since I've been on the internet, even during the dot-com bubble. It's not my fault your gold stocks went down. These are markets. You need to understand how they work. Ultimately, they're going much higher. Fortunately, there's people out there that will sell and swear them off now because they're just running around chasing that shiny object. So what are fund managers underweight? Well, again, as they were last month and the previous month of that, energy. I want to kind of talk about this. We have this sentiment in the market now. We're going to have a recession, trade wars, all of these things. And yet, oversupply of OPEC, the IEA said this. We know that. Why is anybody listening to the IEA who's never been right about demand or supply in years? And we're going to have this oversupply, and there's this at sea oil that's going to hit the markets, yada yada yada, and yet the price seems to not want to break and go lower. We have people out there forecasting, these crazy numbers, 20, 30, $40 a barrel. I guess anything's possible, but what is most likely? When all of this bad news is hitting a market and the price doesn't buckle under it, that should be telling you something. Maybe all of this bad news is priced in. Again, we buy what's undervalued here, not overvalued. Again, everybody hates energy. Again, from the fund manager survey, massive underweight in energy. I wanted to show this chart. It was indicative going back to gold. This shows the flows of capital and billions into gold ETFs. And then you have the gold price, basically gold colored here. And you see as gold rocketed from during this summer as it made its, went up basically parabolic, you see how money flowed into the ETFs. This is very instructional. This is chasing the shiny object, momentum. There are traders out there, people that just trade, people that follow momentum. They track what's going up. They have, tools even on stock charts that I use. Show me things that were the 50 days cross the 200-day or the new highs list. I look at these things too for indicators because something that's made a new high typically can make further highs in subsequent days and weeks. And so that's called momentum. There's a lot of money that trades that. It's hot money. It doesn't care about the physical deficits. It doesn't care about the debts. It doesn't care about government malfeasance, undermining currencies. Why we buy gold, why I buy gold. And it doesn't care about that. It cares what's going up. Gold go up, I buy. Gold top, I sell. That's what happens. So you have, as I've said before, remember what Stan Druckenmiller said. In the short term, in the long term, fundamentals absolutely will determine where stock prices go and such. That is without argument. In the short term, sentiment and liquidity is what determines prices. Okay. And the sentiment was very bullish. Everybody's piling in, it's going up. Okay. FOMO, fear of missing out, greed. Okay. And so you saw the money pour into the ETFs. What do? They have to go out and buy gold. So this is what happens. Uh, and so you get overbought in the short or medium term, and then things have to consolidate and pull back for the next, so you can set the stage. All that hot money has to get out, and then you have to become oversold or consolidate the gains that you had, and then that sets the stage for the next leg higher, and that takes time. I mean, this is not hard to understand. So I thought this was a great chart from RBC Capital Markets. It says this is talking about the GDX. GDX price corrections in bull markets represent a median 17% decline. So it said gold price correction summary. So you go over here. This is showing you the GDX price, and it's showing the last top at $84, which is a recent, and the median correction is 17%. So from the top, you could say, okay, well, the typical median decline would take us down to 70. And I think I have the chart here. You can't see it that well, but you have the 50-day moving average and the 200-day moving average. Now, let me explain this. I'm not a big technical analyst. I don't have a CTA, not a certified technical analyst, but I do use charts because they do give you indications. Like I like using stock charts. It shows me relative strength. It shows me the MACD, which is crossed over. These are all tools I use. I was early on saying that gold was making an intermediate top. I was castigated in the comments in the videos that I said it over the last several weeks. And then finally it topped out. Doesn't mean the gold bull market's over. But when something gets this, when you have a 200-day moving average in an uptrend, you have to give the benefit of the doubt to the asset, whether it's a stock, an ETF, or gold in this thing. It's in an uptrend. Okay, the 200-day moving average is in an uptrend. The benefit of the doubt is that you're still in a bull move. When you get this far, the 200-day moving average, if you go back and look at charts, you will see that in the long term, that can give you a good indication of, and you need to understand how moving averages work. I'm not going to get into all that. It smooths out all the daily and weekly, depending on the time frame you're looking at, okay? And so it smooths out all the daily noise. The overall trend obviously is up. You have to give it the benefit of the doubt when you're in an uptrend like this. But when you see the price get this far above, you will notice if you look at charts of any kind of stocks, most asset classes, stocks, ETFs, commodities, if they're in a bull market or bear market, they tend to hug or stay around that 200-day or even that 50-day moving average. The 50-day doesn't typically get this far above the 200-day. And so that starts that 200-day when you get 30+% above the 200-day moving average, that starts acting as a magnet to pull it back in. Okay. It's telling you this is way above what's sustainable. And then you have confirmation with relative strength, you know, at these huge levels, extremely overbought. And then you have a rollover, a topping, and then rollover in the moving averages. And then when the black line crosses the red line, that's usually not a good thing. Conversely, when you cross over this way, you can see how this works. Now, it's not infallible, but these start lining up and telling you, hey, we need to have a correction here. Plus, when you add on the other sentiment indicators that you see, when you go look at Google searches for how to buy gold bullion through the roof, when you see people, regular retail people lining up on the street buying bullion, uh, and then I get somebody in the comments, well, most people in the US are selling their gold. Okay, go buy at the tops. I'm not telling you not to do that. Do what you want. You're full grown. I'm just telling you that if you want to maximize your returns, it's probably not the best idea to buy at the tops. In a bull market, you buy the pullbacks. So the question then is, if I never had a position in gold and all of a sudden yes, I think that gold's going to move higher and gold stocks are a way to represent that view uh, for outsized capital gains. Well, when should I buy? Because right now they're in a pullback. Well, again, you see showing you how it's overbought or it was, how it's consolidating now. Okay. And so the first stop was the 50-day moving average, just like RBC was talking about. The median correction is 70. Well, we're there right now. We're at the 50-day, but we're still, because this was such a big move, we can expect, it's not guaranteed, but the probabilities are that we will consolidate further down towards the 200-day moving average. It wouldn't be out of the question to take a trip all the way down to a rising 200-day moving average over a period of week or maybe into the end of the year. That is a scenario that's plausible. That would be a tremendous buying opportunity. We need to see this RSI bottom, where it's going to bottom. We need to see MACD make its bottom and start rounding out again. You can see how this works. Okay. And then we will see these different indicators start lining up. We need to see the sentiment cool down, drive out the hot money, calm down the fever, the gold fever. And that's going to take some period of time. That will then set the stage for the next move higher. So what does RBC say? It's, well, one standard deviation correction could take you down to 64. That's right in here. A two standard deviation correction takes you down. That's a 30% decline, takes you down to 59. Now you're getting close to that 200-day moving average. And a three standard deviation correction would take you down to 54, which is the 200-day moving average. Now remember, every day that goes by that this gold price stays above the moving average continues drop off the last, the first, and then add the most current price. So you will see, as long as this gold price stays above the moving average price, you will see this continue to move higher, and at some point they will intersect. To have a three standard deviation correction, that's a big deal if you know statistics. So we can be watching this, and it's going to take time. This won't happen next week or in the following week. This will probably take a couple months. It'll probably take into the end of the year at a minimum. So you got to be patient. A lot of people aren't patient though. So if you don't own any gold stocks and you want to buy, probably not the best time to buy because we're probably looking at further corrections. Need to work off this last move and digest it. get your shopping list together, because if we get, at some point, the probabilities will shift to, okay, now we're oversold. We've worked off it could take it a year. In uranium, it took over a year for this to happen until the previous FOMO gain that we had, and then it digested, but it took, and everybody abandoned the sector. But the fundamentals didn't change. So it's the same thing is likely to happen here. And if we get down to the moving average, kiss it, that wouldn't be out of the question. It happens. This is a volatile sector. So we have to watch it and we have to see what happens. Now there is a chance, it's not a zero chance, that we've seen the bottom and it rockets up again. We have a pretty big gap down here that, at some point in the future will likely be filled. But the probabilities tell us, and previous market action tells us, and experience tells us, that we got extremely overbought. We had a lot of momentum come in, and now the tide came in, lifted everything, and now it's rolling back out. The hot money's leaving, looking for the momentum. People are, the trade's breaking down for these momentum people, these traders, short-term people, which is fine. This is how markets work. And so this needs to consolidate this gain. I mean, this is a tremendous move in 2025, basically over 100% return. This is just in the index. Individual golds and silver stocks, some of them went up hundreds of percent. And so it wouldn't be out of the question to see this pull back and digest these gains in the context of a longer term secular bull market. We saw this the other day. Newmont had blowout earnings. I think they were up 20%, and then year over year, they're up over 100%. But the stock went down. One of the reasons is what I've talked about before. It says here, Newmont falls as 2026 guidance disappoints. Exactly. Now the majors are getting to the point, and people are looking at it and say, well, where's the growth profile? Where's the growth going to come from? Because further gains in earnings, if your production isn't growing, is incumbent upon a higher gold price. Now, the average gold price received, I believe, by Newmont, I looked at the earnings, was 3,500. Okay. So this thing's a cash flow machine, obviously at 3,500 or 4,000, whatever gold's at right now. Okay. So as long as gold stays above 3,500, we can expect similar earnings. But where's the growth? Where's the production growth? And this is what a lot of the large miners, but this sets the table for the next wave of. So what's Newmont going to do? Newmont doesn't have a huge exploration office that goes out there and does all this drilling. Yes, they drill around their properties to try to get resources from inferred to, move them up the ladder to measurable. But greenfield projects, they don't typically, these companies, large companies, don't do that. That's one of the things they got rid of. And so that tells me, I think Barrick is already going to be making a move or Newmont's going to be making a move for Barrick's Nevada assets. Okay. And so what are these companies going to do to get production growth with their huge cash flows, mergers and acquisitions? So I think after we wash out the gold stock correction that we're going to get, one of the things I think is going to be a catalyst to kick off the next leg higher will probably be a lot of these companies are already probably sniffing around, identifying with these huge amounts of cash that they have on their balance sheets, say, okay, we need growth because these are extractive industries, and you know how that works. If you're not growing production or replacing what you've produced, you go out of business at some point. And so the next wave is to go out. It's easier to just go out and buy a developer, buy another company that found a mine and is in developing it. And so I think we're going to see that's going to be the next wave over the next year or so or more that's going to carry us possibly higher as far as the gold stocks. But first, we got to work off this correction. I mean, if you looked at and listened to the call, it was tremendous. I mean, a lot of other gold stocks are going to report in the next week or so. Gold companies and their cash flows are going to be tremendous. But it's like, okay, what have you done for me lately? What's next? So I wanted to show this. Again, I think that AI, regardless of the fact of what you think it's going to do for society, business, the impact it's going to have on the economy, I mean, it goes without saying it's probably overvalued. So this is the uh, this outfit Investec Research. Here's their internet index from 1995 to 2002, the tech bubble. And once it topped out, their internet index went down 91%. This is what happens when things go parabolic every single time. Rocket ship goes up, runs out of fuel, rocket ship come down. And so if you're buying all these AI stocks up here, well, maybe it continues to go higher. Maybe this is the time where this is so transformative, it's going to change the world so drastically that I just don't get it. But I wouldn't touch these things with the barge pole. The time to buy, if you had the insight, was back here. And there were people that did that. But this is outside my circle of competence. But when I see this, hey, what are the probabilities that it continues higher? Maybe for some point in time, but it probably doesn't double from here. You're already up 1,500% in 5 years, 3 years. We've seen this many times. And this is instructive for people in the gold market. You know, you see, yeah, or the uranium market. You see how this thing went up 1,500 times. This is just an index, artificial intelligence index, or the same thing with the internet index, how it exploded upwards. And how if you catch a market that's in a bull market where everybody's piling in, which I think is happening in commodities and resources is going to happen over the next several years, you can see what can happen. But notice it's not a straight trip. This is indicative. Look at the pullbacks that you had to endure. Okay. Same thing can be shown with look at the previous uranium bull market in the teens, 20 teens. Look at this recent gold move. Same thing. Okay. So you could see this big move here, and people could say, well, it's over. But then you have this pullback, which drives out and consolidates, and then you make the next move higher. But at some point, you you know, our goal, this is what people don't seem to understand. Let me reiterate this. When we're dealing with these kind of markets where they're running like this, no one is buying right here and selling right here. There, you may find one or two people, but that's luck. You can't do that consistently. When you see these big moves in stocks or commodities or what have you, asset classes that trade, our goal is to capture the big chunk in the middle. Identify a trend. Okay, it breaks out. Let's get in. Maybe we don't catch the exact bottom. Maybe we see the breakout here. Okay, I'm just using this as an example, just based on the chart. We we get in here, it moves. Maybe we even get out here. This is what happened to me in Bitcoin. I got out way too early. Okay, but if you have 1,000% move or a 500% move in an asset that you have a lot of holdings in, it's life-changing wealth. You don't have to catch the exact bottom and the exact top. All you have to do is identify these trends where you have these big moves over, and they take years. Look, it took 2022, 20, or going back here, 95 to 2002, it was all the way up and all the way back down round trip. So if you just caught most of the move over that period when it broke out, 2024 or 95, 2000, whatever it was, the years. It's the same thing here. If you catch the majority of the move, isn't that enough? You're not going to, but what happens, as I've said before, is because it happened to me when I was younger and I didn't understand how to control my emotions, you get the FOMO. You start creating scenarios in your head how this can just keep going higher and higher and higher. And it never eventually comes back to earth. Things get overvalued. Things become a bubble, and you have to recognize it. It's all right to trade bubbles. It's all right to be in them. Just make sure that you capture, our goal is to capture the majority of the move, a big chunk of the move, not buy the exact bottom and sell the exact top. It's impossible. And anybody that says they're doing that consistency, consistently is lying. Show me that. Do that over several market cycles. It's not possible because no one can know the future with any certainty. So the goal is to catch the majority of the big moves. That's what we do. We identify the undervalued sectors, get in, got to be patient, and then when they inflect, try to capture the majority of the move. So I've said this ad nauseum. Global conventional discovered volumes, billions of barrels of oil equivalent. We're just not finding enough oil to replace what we're producing. Current consumption, I've said this before, we are consuming over 30 billion barrels a year of oil, and we're just not replacing it. And there's charts that even go back further. And you see that, eventually this inflects and becomes a problem. You need to have a price that sends signals to the market that say, we need more oil. Are we there yet? I don't know. But when I see all the pessimism, when I see all the negativity, when I see the sentiment the way it is, and everybody piling on telling me all this negative news, but then the oil price doesn't break, then maybe oil does go down to 20 or 30. Then it's another buy of a generation. It's not going away. Demand continues to increase every year, and its depletion is there. Depletion is relentless. It's that gremlin that's there that people forget about. Depending on who you want to listen to, is it 6, 7, 10% a year on over 100 million barrels of demand, plus growing demand of 1 to 1.5% a year? Again, you have to find a new Saudi and bring it online every year. It's not happening. So at some point, it's going to be an issue. And oil demand is not rolling over. It's going higher. Now the sentiment in the market, the zeitgeist, remember when we talked about nuclear 3 or 4 years ago? Nuclear doesn't work. Renewables. Remember what I was telling you? The zeitgeist is going to shift. Nuclear will be a growth industry again. People castigated me, poo-pooed me in the comments. You don't know what you're talking about. I mean, I built, you know, that was my circle of competence. I built thousands of megawatts of renewables. Yeah, they produce when the wind blows and the sun's out, but they don't when the wind doesn't. I knew you weren't going to have a technologically advanced society that consumes 100 terawatts a year of energy and growing based on intermittent power and battery backup. It wasn't going to happen. And so it was obvious to me that even in places like Japan, where you had the Fukushima, eventually time heals all. So what do we now? Everybody agrees that nuclear power is the future. I have one country in Europe, Germany, that's an outlier. Everybody else is expanding their nuclear power portfolio or intends to build new nuclear power plants. If you've been with me for some period of time, you've seen it. We've talked about it. The same thing's happening in oil. Oil's going to go away. EVs, you know all the stories. And so now even the IEA has had to shift. That's a globalist entity that was spouting off the WEF ESG nonsense politically. You had the head of the IEA saying, stop drilling for oil while demand continues to increase. Well, when the prices went down, and people say, well, why is the price down? Because it's cyclical. We don't know exactly when it's going to bottom, but we can look at the indicators and say, when everybody's negative on it, when everybody has a reason why it's going to go down further, when everybody is on the same side of the canoe, it usually pays to be on the other side. And sometimes, again, you don't catch the exact bottom. You don't know when sediment's going to shift again. So you have to sit there and be patient. Now you can get rid of some of that opportunity cost if you want to get and look at charts and say, well, I'm going to wait for the breakout. I'm going to wait for this thing to actually confirm. You give up some of the upside when you do that. But like I said, I'm happy in the portfolio I have of oil stocks to sit here and collect, the stocks that I own have paid down a lot of their debt. They're cash flowing, even quite nicely at these prices, and they're returning capital to shareholders via dividends and buybacks. What's the problem? And because of the oil price, see, this is the interesting thing. People say, well, if the oil price stays low, won't that affect the payouts? Eventually, yes. But what are they doing instead? If you're one of these big, large companies, you're looked at as an income producer for your shareholders. People want the dividends. The board of directors of XYZ International Oil Company that pays a equivalent 5 or 6% yield is going to do everything it can before it has to cut that dividend because it knows what that means to its shareholder base and to its reputation. And so they'll cut back on exploration. They'll cut back on they'll delay making final investment decisions. That's what we're already seeing with some of these companies. Okay, they're saying, well, we're not going to move. We have this project. We're seeing that offshore in Namibia with like some of these companies. We're not going to move forward right now. The oil's there, but we're just going to hold off for a while because the price doesn't justify us moving forward. That exacerbates the situation that we have here because the longer people wait or the more capital that's held back from exploration and development eventually leads, low prices cure low prices. So if you remember, I think it's going to be an excellent opportunity in the UK North Sea. If you see a political change in the UK, which I think is eventually coming, obviously this is a UK offshore oil and gas output sees declines. It was already kind of in decline. Fields are mature; they need to be invested in to hold production. But if you were paying attention, during the whole inflationary scare post-COVID, when oil prices went up because of the Russian invasion of Ukraine around this time, the brainiacs in the UK decided to throw an excess profits tax on the UK North Sea companies that were operating there. I think it was 78%. Uh, and so when you raise taxes on something, you get less of it. And so the incentive to go out and reinvest, you had natural decline here, and then they kind of stabilized it. And then since the taxes, well, you've seen what happened. Production has almost decreased by a third over the last 3 years. This is what you would expect to see. There's no incentive to go out and spend money there. So you can just give it to the taxing authorities in the UK. Now, if you get a government, now I have a whole list of great companies that have great assets on my watch list. And if we have a change in government and they rescind this, then you'll see that change. But this is a perfect example of what happens when you don't understand how the real world works, which is typical of politicians in the West. These people, what are they? Most of them were activists or lawyers, or these people don't have any real world experience about how things really work. They're on the ESG thing over there. Okay, that's why I have some of the highest energy prices in the world. That's why industry is running away and closing down in Europe and in the UK in particular. All right, stay poor and cold. Eventually, people will realize that they don't want to be poor and cold and reverse course and put people in there that will say that they're not going to keep them poor and cold. It's inevitable. So here's the short positions. That's why I say oil is the contrarian trade. It's even more, uh, they've poured the short positions on heavy. This goes back to before 2012. So you have over 13 years of data here, and this is the most short that people have been uh, Brent crude going back 13 years. That should be telling you something. I guess it could go down further. I guess the shorts could be right. I guess we could have a global recession. I don't see it. I think, you know what I think? We have all these central banks around the world for the last 2 years have been massively cutting rates. The United States now is in a rate cutting cycle. Liquidity is going to be there. PMIs are picking up. You're seeing breakouts across the commodity sector, whether it's copper, aluminum, what have you. Oil, where if you believe we're in a commodity super cycle and gold led the way, now it's trickling down into the other sectors, which eventually be oil. So maybe oil can make one more thrust down to 50 or 45 or 20, but I don't see it. I don't see it. This was amazing. This is from the U.S. Energy Information Administration. U.S. oil demand at 18-year high. Well, I thought we were in a recession. U.S. oil demand is set to rise in 2025 to an 18-year high, and further increases can put American petroleum consumption above the 2005 all-time high. Well, what's going on here? So again, maybe I'm misreading this. Maybe I just don't see all the recession we're getting ready to have. You know, maybe you already had the recession. So we'll see what happens. But you know, and again, what's interesting, and I am aware of the fact that bias is there, and I am biased towards wanting higher oil prices because I have oil stock investments. And so I'm going to be partial to promoting data that bolsters my position. But getting away from looking at the entire world, for example, instead of just one area, is sometimes the best way to do this. And the fundamentals, as I've explained before, are we're using more oil around the world every year. We're going to continue to do that for the rest of my life and most of the rest of you people that are listening to this lives. And that requires continuous investment. We have not seen it. We're on the cusp of what I think what you saw in gold, what you're going to see in other commodities is going to happen to oil. Eventually, we're over the next several years, I don't know exactly when, my projections are that oil is going to make all-time new nominal highs. That's over $200 a barrel at some point. Now, I can't tell you when, it's impossible, but that's what I think will eventually happen. So copper is looking like gold before it broke out. So here's the gold chart going back to 1995, big cup and handle. Remember, we were talking about this when it broke out. Um, we caught this trend. We were talking about it on this channel. We talked about it in the newsletter. You saw what happened after we saw the broke out. Classic cup and handle. A lot of people would say that our CTAs, well, when you have a cup and handle of this duration of many years, it isn't necessarily that predictive, but this is what did it happen. And so again, probabilities, observation, that's what I go by when I'm looking at these things. And so I say, okay, hmm, what is a similar setup? Well, here's copper, basically back to 1994, 95. You kind of can make the case that there's a cup and handle here, but we're looking now. This is the current price. This is projected if it goes like gold did. You know, are we looking to break out on the upside? I think we will break out. I'm looking for confirmation here. And then I think we could see a very rapid move higher. Now, the fundamentals are there. We had the Grasberg issues at the Grasberg mine, the mine in Congo, Ivanhoe, the situation in Panama where the Cobre Libre mine, I think it is, confiscated or shut down, and Panama, I think it's in Panama, demanding, more of an economic interest. That's in total 9% of world copper supply. Then the ongoing issues with the legacy copper assets in Chile, the world's largest copper producer. And again, with the world cutting rates for 2 years and liquidity increasing and global PMI starting to move higher, uh, you need copper. Notwithstanding the fact of the electrification, the AI boom, all these other things that require electricity. And so we have lower supply, yet relentless increases in demand. I mean, people have done the work. Even Goring and Rosenzweig did the work where they show what at certain per capita GDP levels, how many pounds of copper that take. And the developing world, the emerging markets are tremendously way behind what the developed markets are. I don't remember all the numbers in my head, but it was astronomical the amount of copper that's going to be required as these countries continue to move up the S curve and get wealthier and wealthier, it requires more and more copper because of electricity demand, air conditioners, refrigeration, all the things we take for granted. These things are still growth industries in places like India, notwithstanding the fact that data centers and all that stuff comes into play. Then if you want to be Mr. Renewable and talk about, solar farms and all this stuff, substations, well, that's even more copper, transformers. And so you see, if we have deficiencies in supply, and of course we've had underinvestment there also, and you take supply off because of these issues we've had, these large mines, well, there's a setup, there's a potential. It's worth looking at. I think, you can make the case how we go to $10 copper. I remember Lee Goring at Goring and Rosenzweig saying that 5 years ago that he saw copper. There's no reason why copper couldn't go to $10 a pound over the next decade. It looks like that's going to happen or could happen. And so we have to be, positioned for that. Now, it's not confirmed on these charts, but the setup is similar. And that's what we look for. Last but not least, I found this interesting top-down charts on Substack. Outstanding. I love the guy's charts. He does tremendous work. Euro Stocks 50. Uh-oh, breaking out. 25-year, basically nothing happening. And now something looks like it might be happening. I don't know why. Again, this is another example of what's it telling us? Is it telling us that the EU's in trouble? Is it telling us that there's these governments the sclerotic EU is in trouble and we could go back to some of these more market-friendly governments that the EU would weaken and national governments would come back into prominence and put forth, I don't know what it's telegraphing, but this is interesting when you see basically nothing happen for 25 years and then a breakout. It's kind of worth looking at. That doesn't mean rush out and buy European stocks tomorrow, because the sentiment is still negative there with all the problems they have. But what is happening? Are we going to see a shift from the old statist mentality to maybe more market friendly? I don't know. They have a lot of problems. But again, markets move in anticipation. And Stanley Druckenmiller has said many times, you look at the current stock price or the current price of a security or asset, it's reflecting present day conditions. So you have to look out 18, 24 months if you want forecast. What's going to happen over our elections? Are things going to change? We'll see. There's a lot of politicians in the EU. Is this telling us that we're going to have a resolution to the conflict in Ukraine, and that's going to cause political upheaval such that a lot of these post-World War II neoliberal jerks are going to end up losing their position? I don't know what it's signaling, but this is an interesting thing to keep an eye on. Again, we're always looking for the next big move. Okay, guys, that's it for this week. Thank you for showing up. Appreciate your support. The newsletter, since I've been concentrating more on making the product better, running it like a real business, it's really, really moving now. There's a lot of times I'm on the top 20, top 30 of the rising in finance on Substack. That's all because of you guys. Again, I think that we offer a great product. I think that you will find it interesting if you are patient, if you are a long-term investor, if you want to buy things that are out of favor and sell overvaluation and buy undervaluation. If you have that mentality, then that's what actionable intelligence is for. And I hope that you will join us. Thanks again, guys. We'll talk to you next week.